As we wrap up 2023 and look ahead to 2024, we wanted to answer a lot of the common questions that we're getting from you and our other clients. So we decided to have Mrs. Q back in for a hypothetical portfolio review. My portfolio has gone sideways for 2 years now. Is this normal? We looked at every rolling 2-year period going back to 1927, and we found that 182 of the 1,134 rolling 24-month periods were negative or flat. So while the markets have been roughly flat for the last couple of years, that's not at all unexpected. And it may be a good sign as we look ahead to 2024. Of those negative rolling 24-month periods in the past, the future 12-month returns after those periods averaged 19% for dividend-paying stocks. My growth portfolios had a great year in 2023, but my dividend portfolio lagged. Why? First of all, let's clarify what we mean by growth and value. A growth stock is where the underlying company is growing its earnings and its sales faster than the average company. These companies also tend to have higher price-to-earnings multiples, reflecting the market's rosy outlook for their future growth. Value stocks, on the other hand, tend to have lower price-to-earnings and price-to-sales multiples, and if they pay a dividend, they tend to have higher dividend yields. DCM's cornerstone and income builder strategies fall into the value category. Large growth stocks had a much better 2023 than large value stocks. Growth went up 32%, whereas value stocks only went up 7.7%. The simple explanation for why this happened was simply they had such a bad 2022. Large growth stocks were down almost 30%, whereas large value were only down about 6%. So much of 2023's performance is simply recovery from 2022. It's also important to remember that the math of compounding favors stocks that have less volatility. So if we look at the multi-year performance between growth and value, we see that every $100 invested into large growth for both 2022 and 2023 would have grown to $93. Meanwhile, every $100 invested into large cap value would have grown to $101. Does DCM think growth stocks will outperform again in 2024? More importantly than the tilt between value and growth, we believe tilting more towards quality in 2024 will be more important. Both quality growth and quality value could have a good year. The main reason we're favoring quality is because recession risks are certainly higher than they have been in the past. So if we do get a down market, it is those high quality names, specifically high quality dividend payers, that will likely perform better. In down markets, dividend growers have historically fallen 9% on average, compared with negative 24% for non-dividend payers. You mentioned the potential for a recession in 2024. Will we have one, and if so, when will it start? At DCM, we tend to invest on the merits of the individual companies that we buy, not based upon our own or anyone else's economic forecasts. Economic forecasts tend to be notoriously difficult. To illustrate, consider the U.S. Federal Reserve. At each of their Federal Open Market Committee meetings, the Fed predicts what they think the federal funds rate will be in the future. The Fed's predictions about its own Fed funds rate are illustrated here with the green dots. The blue line represents the actual Fed funds rate. And we can see just how badly the Fed has been at predicting its own interest rate. In 2015, for example, the Fed expected interest rates to rise dramatically over the next couple of years. However, the Fed funds rate raised only moderately. The Fed expected to maintain Fed funds rate at elevated levels going into 2020. Of course, the pandemic required that they cut interest rates back down to zero. And then following the pandemic, the Fed thinks that inflation is transitory, so they predict the Fed's funds rate will stay low. And of course, we know that the Fed ended up hiking rates to over 5%. And if the Fed is unable to accurately forecast the Fed funds rate, which itself sets, how do we expect anyone to be able to forecast the overall economy, which has infinitely more variables, none of which we control? Many of the greatest investors of all time have completely ignored economic predictions when making their investments. Consider this quote from Warren Buffett. Economic predictions just don't enter into our decisions. Charlie Munger, my partner, and I, in 54 years now, never made a decision based on an economic prediction. We make business predictions about what individual businesses will do over time, and we compare that to what we had to pay for them. But we have never said yes to something because we thought the economy was going to do well in the next year or 2 years. If recessions are virtually impossible to predict, how can we protect against them? We do that in 3 main ways. The first is that we only invest in high-quality companies that have ample free cash flow to not only cover their future investments and ongoing needs, but in many cases have plenty of excess cash flow to pay dividends and buy back shares. The second is through dividend income. As long as you are spending the dividend income produced by your portfolio and that dividend income continues to be paid in the future, then falling stock prices really have no impact on your overall well-being. And third, we use high-quality fixed income. Bonds have historically been the best hedge to stocks in a recession. Interest rates tend to fall in recession, which means bond prices tend to increase. 2024 is also an election year. What does that mean for my portfolio? If you polled people and asked them which variables they think drive the stock market, certainly politics would be close to the top of the list. Surprisingly, there has been no meaningful difference between political parties and stock market results. Research from Princeton University suggests that neither Republicans nor Democrats had a statistically significant impact on future economic growth rates. Stocks have also went up in 85% of all election years. In the 12 months preceding an election, they've gone up an average of 8.4%. In the 12 months following an election, they've tended to go up 9.4% on average. The bottom line is that you should not let politics drive you to cash or to make any meaningful changes to your portfolio. If you had invested $10,000 in the S&P 500 in 1972 and stayed invested the entire time, your portfolio would have grown to $1.9 million. If you had gone to cash every election year, that portfolio would have only grown to $1.1 million. The U.S. national debt is on everyone's mind this election season. What's going on? Is our country going broke? We certainly don't love the current debt level, but we don't think the U.S. is going broke. To illustrate, let's say you and Mr. Q have $198,000 in mortgage debt that's currently costing you 3% per year. Your household earnings are $140,000 per year. Would you consider that household to be in a financially perilous condition? While your debt is definitely higher than your income, the cost to service that debt is quite a bit lower. What I've just described is the United States' collective financial position. If we divide the current debt, which is about $34 trillion, by the total U.S. population, the national debt per person is $99,400. Our economic output, which is measured by GDP, is $27.6 trillion, or $81,000 per person. And right now, the effective interest rate on the U.S. national debt is under 3%. And if we look closer, we see that 73% of the U.S. national debt is essentially owed back to ourselves. Domestic investors, such as people buying U.S. Treasury bonds, currently hold 36% of the debt. The U.S. Federal Reserve owns 17%. Future Social Security obligations make up 10%, and then 9% is covered by military retirement, civil service retirement, Medicare, and other. Only 27% of the national debt is loaned to us by outside investors, with the number one country being Japan. So not only is the debt fairly reasonable on a per-person basis, particularly considering the income and low interest rate, but much of that debt is actually going to be paid back to our own citizens. Is it possible to push the debt and deficits too far? The United States controls its own currency. That means that we can cover any obligation that we take on. All we have to do is print more money and we can satisfy basically anything. If the US government wanted to send $1 million monthly checks out to every one of its citizens, it technically could do that. Of course, the result of that would be rampant inflation, which is the biggest concern, not bankruptcy. Inflation has been a massive problem over the last few years, but seems to be cooling off. Is the Fed done raising interest rates? Based upon the current trajectory of inflation, we would think so. The Fed's target is 2% per year, and right now the bond market, as represented by the treasuries, is implying that bond investors believe inflation is going to be right around 2.2% over the next 5 years. That wraps up our meeting with Mrs. Q. If you have any other questions that you'd like to ask, feel free to send us an email or contact your portfolio manager. As always, we thank you very much for the opportunity to serve you and your family. Thanks for watching, and we'll see you in the next video.